This panel on the retail investment strategy. My name is Hannah Brenton and I'm a finance reporter at POLITICO. Thank you for joining both in person and online today. We will be taking questions at the end from the room for 10 minutes, so please start thinking about that. And this panel will focus on what is our kind of hotly anticipated strategy from the Commission. We're going to talk through what problems the strategy is trying to solve, the thorny political issue of inducements, and any other elements that might be included in that strategy. So joining me in the room is Carole Anou, Chief Executive of Centre for European Policy Studies, Anne de Lanversin, Chief Executive Officer of Generali Global Pension, and online is Sean Berrigan, Director General of DG FISMA, the European Commission's Financial Services Department, and Andrej Kovarik, a Renew Europe MEP from the Czech Republic. So thank you everyone for joining me. So if I could start maybe with Sean to set the scene for what the Commission is trying to do here, if you could explain a little bit what problem you're trying to fix with this strategy. I think you're on mute still.
Oh, no, we heard him.
I am indeed. Sorry, thank you. Good morning, Hannah, and good morning, everybody. And I apologize for not being with you in person, but I'll do my best from remote. I think the answer to your question is a little bit in the title, in the sense that we see the retail investment strategy as an important component of the overall strategy for building a capital markets union. I mean, those of you in the know will know that a key difference between the strategy we had for capital markets in the last mandate and in this mandate has been that we have focused more on the demand side, and we have in particular focused on increasing retail participation on the demand side of the market. We have in the EU a disproportionate level of retail deposits, and we would like some of those to move out into the capital markets for economic and indeed social reasons. But if we are to attract those retail depositors out and into the capital markets, we have to make sure that they are appropriately and adequately protected inside the capital market. And in recent years, we've been gathering evidence around this. And we've identified a number of concerns, let's say, about the protection of retail investors in the capital markets. One thing to note here is that the information asymmetry is quite extreme. I mean, we have conflicts of interest in other parts of the capital market and the financial system, and we manage them. But in this particular case, we have to be alert to the fact that the information asymmetry is rather great between those on the financial side and, of course, those coming in from the retail side. And so despite the rules on transparency that we have in place, we have found in our consultation and in our study that retail investors do not in fact read or fully understand the information that they are provided. Similarly, in terms of disclosures, we have rules in place, but we found that those disclosures tend to be complex and they don't tend to be well adapted to the retail market or to the digitalized environment in particular. We know that retail investors receive advice, but despite, again, the regulatory obligations in place for advisors vis-a-vis their clients, that advice we find may be biased in favor of specific products, either because the advisor is tied to a manufacturer or is paid a commission by a manufacturer. So a combination of the information asymmetry and these potential conflicts of interest that arise creates a sort of high risk of negative outcomes for the retail investor. And so the evidence from this study, as I said, and public consultations that we have done suggests that retail investors are in fact too often offered products that are not cost efficient, thereby reducing their returns over time. And not all their products that are offered are actually deemed to be value for money. And I think if retail investors do not feel protected in the capital markets, or if they come into the capital markets and have a bad experience, then we're not going to be able to attract them or keep them in the capital markets, which is something we want to do, as I said, for many economic reasons, but also for social reasons, looking forward in terms of the future provision of pensions. So for all these reasons, we've been developing in the Commission a retail investment strategy that aims to reinforce the existing investor protection framework. And we focus potentially on a range of aspects. I mean, obviously, the one that's getting most attention now is the possible work on inducement and a possible inducements ban. But you should also be aware that there will be other parts of this strategy as well. We will look at disclosures and marketing communications, value for money, suitability, appropriateness assessments, client categorizations, professional certification of advisors, supervisory enforcement, financial literacy. So there will be a wide range of issues in the strategy, not just inducements. And I should add that no final decisions have yet been taken on exactly what will go in the strategy and what form any action we will take on any of these headings will be. But it's clear that we expect and we want to attract retail investors into the market. We know that at least for the time being, although the situation is evolving, most of these retail investors will access the market via intermediaries. So it's really important for us that this relationship between the intermediary and the retail investor is such that the interests of the investor is protected. I'll stop there, Hannah, maybe, and take any listen to my fellow colleagues.
So let's come back in a little bit to some of the solutions that you have on the table. But Carol, if I could ask you, do you agree with that assessment that there's a kind of cost efficiency problem and a lack of transparency for retail investors?
Yes, indeed. I think John has outlined it very well. Let's say these are the problems which we see, by the way, since a long time. And basically, it's to be regretted that we haven't been capable to acting on this. But basically, you have to see it as for my part, as a win-win issue. We see that if we compare to the United States, which have half as much in funds as the United States, and we have the double of deposits than the United States. And we know deposits, certainly over the last years, hardly brought on anything. Today, we're in a context that the transmission of the higher interest rate to deposits has also always been delayed, meaning the burden of low interest rates, and today, let's say, of higher interest rates, but the way it's translated into deposits is borne by consumers. So consumers, if they then look at alternatives, they think, look, should I invest in funds? And then they look to the investment fund market, and there you see also, again, the opposite of the United States. A cost of funds in the US is 1/3 of what it is in Europe. And then the markets, the market participants, say the banks, the distributors say, look, we have to keep it bundled because this is to pay for advice, but the cost is so high that this is a disincentive for the consumer to invest, which we see in the data. Because if it's at least 1.5% or 2% on the average ongoing cost without the entry cost, without the exit cost, this is a huge disincentive to go into the market for a consumer. And that's what you see. That's what we know, by the way, since 10 years. That's what we see in all the data. And that's why I think a strong Commission strategy is needed. It's also related to Capital Markets Union. We will never have the supply of funds for the markets if we don't tackle this problem. If we always keep on saying, look, why has Shell now considered to go to the United States? Why have we got IPOs from London now moving to the US rather than to move to Europe? It's just because we don't have the liquidity. And if we don't address this problem, if we don't say we will now try to develop a win-win proposal to say, look, we will try to increase massively these consumers, convince them to invest in the markets with very interesting proposals that will also be a win-win for our Capital Markets Union, a win-win for, let's say, to get liquidity in European capital markets, to keep IPOs over here, and not to all see them going to the United States, all problems which we know since a long time. That's why this retail issue is so crucially important. And we have seen it, by the way, also in the United States over the last 2 years, how important retail investors are in capital markets. We've seen it in the case of Tesla. We've seen it in the case of some other stocks in the US. We have to, don't think a retail investor is stupid. That is extremely important. A retail investor looks very carefully at what he pays and what the cost is. And if he sees that he pays 1.5% ongoing cost on a fund, he says, pooh, I mean, that is huge. I mean, as compared to if I keep it on a deposit, it's probably a bit better.
And do you agree with that? I mean, the cost of funds in the US is much lower than in the EU. What's the industry's kind of perspective on that?
First, a comment on the comparison between what we have in Europe and the States. There is a huge difference about what we have to save because of the pension system and the protection system, which are so different. So I think that this comparison it's really important to look at all the elements that you listed. But it's as well important to understand that in Europe, we don't have the same need for savings. So you cannot just compare those two contexts roughly like that. If we go back to the goal of the Capital Market Union, of now the retail investment strategy, as you mentioned, with this new direction that you have, and if one of our goal is to expand towards more retail savers, what we have to do for sure is to be more transparent and to create trust. And to create trust, we have as well to provide advice. When we go to advice, there is maybe two different kinds of advice. Advice for people having an extra money, an extra capital, they have something to invest, and they are looking for an advice. I mean, they are really looking for someone giving them a clue on what they are going to do with their money. So it's not a question for them of how much they will invest, but where they will invest. And there is a second type of advice which is needed for more modest people not having this extra money. And if nobody is taking care of providing for them a kind of support or advice, a kind of education towards market, because we have as well to recognize that in Europe, we don't have the same empowerment for savings as the one in the US, and it's all the education which is like that. They really need to have this support. And without the support, there is no saving. So if we want to enlarge the retail investment, we have to give and provide more advice. This is key. And as an insurer and a pension manager, we support the goal of the capital market unions and the RIS, of course. And we consider first that we have to make more private investors investing in the capital market, but second, to give the ability to more people to invest and to save, because it's not because they don't save that they don't need to save. And this is the big difference between the European and the US context.
Okay, Andre, more people need to save in the EU, but is it really like the right time to encourage consumers into capital markets given the kind of volatility we're seeing at the moment?
Yes, thank you for the question and thank you for invitation. Also, my apologies that I cannot be with you in person. I think it's a good question, but we also heard from the European Commission that the strategy would be composed of many elements, and one of the elements is also to make sure that there's a reinforced framework for retail investors in terms of investors' protection, and that is definitely one part that has to be one of the key components of what we would expect to see coming from the Commission. But on the other hand, and I think we saw it specifically during and after the COVID pandemic crisis, there is actually an incredible amount of savings, sometimes quite idle in people's savings accounts or just bank accounts, which are not used. And maybe I would add as a counter argument to what you raised in your question is that we are also in a period of unprecedented high inflation rate, and it is exactly the inflation that is consuming a huge amount of citizens' savings in this regard. So I think that is a good timing to make sure that we can propose a good set of products in terms of retail investment, and on the other hand, to make sure that there is actually a functioning framework that would accompany retail investors on the demand side, that would be transparent, clear, that would use also the possibilities that are currently provided by various digital tools, digital technologies, and also to make sure that we pay attention to the fact that we need to work on issues such as financial literacy to make sure that people are aware, that they know that they make informed choices, that they are aware of their rights, what they are aware of what is actually offered to them, and they are able to also claim their rights in the situation where possibly something goes wrong. So I think all these components make this as more like a sort of a complex strategy that should be provided from the European level. But I'm not really concerned about possibility of wrong timing. We were expecting the strategy even earlier than this year from the European Commission. So I think the timing is actually quite appropriate.
So yeah, that's a good point. We were waiting for the strategy for quite a long time. So Sean, what's been the hold-up? And one of the issues has been whether to bring forward this ban on inducements, which is a big part of the conversation about investor protection. So can you tell us a little bit about where the Commission is on that? How firmly is that still on the table?
Well, first, there's no particular holdup. I mean, we've had a plan for the mandate. The retail investment strategy was always a little bit towards the midpoint of the second half of the mandate, and that's where we are now. So it might have been a little bit for earlier, but not particularly earlier. So it hasn't come. I think it's good that people have been expecting it, but it has not come late in our view. I just want to also make the point that it is true that US have more reasons to save than the EU, but the EU savings rates are high. It is not whether they save or not, it's how they save. And currently they save mainly through holding deposits in banks, and we think there are good reasons, economic and social, to push them into, entice them, let's say, into spending, at least investing some of those deposits in capital markets. Now, the retail investment strategy has had its part of that, and it has become a bit like the MiFID, became very tape-centric. There's a risk here that the retail investment strategy becomes entirely inducement-centric, and I want to avoid that. But since you asked me the question, I will answer it. It is a tricky issue. As Harald has said, it's an issue we've known about for a while and has not really been fully addressed, and we're back talking about it again. As I said earlier, the situation is evolving, but for the time being, at least, we expect retail investors to access markets predominantly via intermediaries. I mean, there are ways to access it directly, but in Europe, at least for the time being, we expect this relationship through intermediaries to hold. And most of those intermediaries, as I said, are tied to a manufacturer of a product. They either work for them or they're paid commission for selling their product. And this relationship between the intermediary and the manufacturer creates a potential conflict of interest. It's incontrovertible. If the intermediary is being paid by the manufacturer to advise his client, the reasonable question is, who is the intermediary working for? His client or the manufacturer who's paying him? Now, we have regulatory requirements. They already exist to manage that conflict of interest. We have language, pretty good language, I think, in MiFID, maybe not so good language in IIDD. And we have requirements on transparency, requirements on disclosure, and obligations relating to duty of care to clients. But as I said earlier, we're operating here in conditions of considerable information asymmetry. So some of these standard approaches to managing conflicts of interest that we deploy elsewhere in the system, well, there's a risk they may not work so well in these conditions where there is such a strong asymmetry of information. And I think the evidence suggests that may well be the case. So we've had, from our consultation, too many reports of bad experience for retail investors. From our study going back in the past, and Carol has mentioned that, we have seen bad outcomes for retail investors. And if this conflict of interest cannot be managed by our standard approaches of transparency, disclosure, obligations for duty of care, then the question arises, is a ban perhaps a better approach? Now, there are kind of two key arguments where you have to think a little bit carefully about this ban, okay? The first is what's called the advice gap. As has already been said, the retail investor probably needs advice, and the argument is that if he does not get it in the form of this commission-based product sales, he or she will not be willing to pay for it as simply objective advice. Or they may invest so that they may not invest at all if they get no advice, or they may invest unwisely if they don't get advice. But again, we have some questions, and the industry have some questions they need to answer here. I mean, firstly, what exactly is the value of advice to a retail investor if it cannot be guaranteed to be unbiased? So if there's a risk that this is more a sales pitch than advice. I buy a car from a car salesman. He gives me a sales pitch. I may or may not buy the car. I'm not obliged to pay him for that advice. This is not free. This is part of the sales process. So what exactly are we talking about when we say advice? And the second is, there is evidence from the Netherlands and the UK that when you change this advice structure, the market doesn't collapse, it changes. And there's no evidence that retail participation in the capital market declines, it just changes. So these are the kind of questions that we're trying to grapple with internally as well. We know we need advice, but what exactly and how can we ensure that that advice is worth actually having and doesn't, in fact, result in just as bad an outcome as having no advice at all? On the other hand, another argument we have to take into account, of course, is that the industry has structured itself based on commission-based sales of retail product. So there's a large ecosystem built around this structure. So any sudden movement could be quite disruptive. It wouldn't be very disruptive for the industry. And that is the case, of course, which has been made to us from the industry side. So we're listening to all sides of this. We're listening to the consumer authorities and the consumer organizations who are arguing very strongly that, in fact, no advice is better than bad advice. And then we're listening also to the industry, which is arguing, of course, that such an abrupt change or an aggressive change might be very disruptive for the industry. So we are listening to all sides, and we, as I said before, no decisions have been taken on what and how the strategy will be constructed. But this is an important issue, and I think it deserves the attention it's getting.
When will you make that decision then? What would kind of tip you in one direction or the other? Because these are arguments that have been around for quite some time now, right? So when does the Commission kind of come down one way or the other?
Well, we have a date in May. So as ever, it's always the calendar that forces you into a decision. So we have a deadline in May. Decision will come in May.
Okay, all right. Anne, sales pitch versus genuine advice. How does the industry see that?
Well, thank you for the question. And once again, I'd like to go back to the comparison between the US and the UK and the Dutch market that you expressed. Because in those three countries, you have group pension compulsory, or at a level which is very, very high compared to the average of the European market. So when we compare the level and the efficiency of savings in those different markets, those three countries, which are more or less kind of same level in terms of group pension, second pillar and third pillar, and the rest of the European countries having very small second and third pillars compared to them, there is bias of comparison. And when it comes to advice, it's exactly the same thing because of this need for education when you are not obliged to save for pension. And if we go back as well to the goals that we all have to expand the basis of saver to more retail, the second pillar could be a very good pillar on which we could that we should promote maybe. Because if you save in your company, you save in a scheme that has been negotiated, which is a fair scheme dedicated for the kind of employee that the company has, and with a full range of services, and most of the time people are saving, which shows as well that if you go to them and you explain the needs they have to save, they do it. And if they don't do it today in the European market, it's because the distribution network is not accessible to everybody. And if we take the example of the companies, SMEs, in Europe and in France specifically, you have only 10% of SMEs which are equipped with corporate savings, workplace saving, when you have 100% of big companies which are equipped. Why? Because they don't need distribution. They don't need advice. They know it's better to provide those kind of schemes to their employees. When you have an SMEs, when you have 3 or 4 employees, which is the case of half of the employees in Europe, it's very difficult to set up by yourself this kind of scheme. And you said it's all this issue around advice is difficult and we have to better understand the impact, and it's true. We have to take care of giving access to savings to people who are not saving, and not only to be sure that the good fund is selected for people who are saving anyway and who are happy to pay for that. That's one of the considerations that we really want to focus on, and we do know that distribution networks are key in helping people to better understand in Europe what it has stake for them.
Carol, distribution networks are key to kind of get people advice from. Do you agree with that, or do you think? How do you weigh that up?
I think in Europe there are enough distribution networks that is not a problem. Let's say we have, of course, banks are reducing their branches, also insurance companies probably reducing their brokerage networks, etc. But overall, we have to see it in a broader context. What is the big problem for Europe? Again, if we have most of the savings and deposits, they don't give a good return. If you see that this in a macro perspective, there's a huge problem for retirement, saving for retirement. Europe, certainly the south of Europe, the majority of the member states, by the way, we have the data in a paper which we prepared for this meeting, are under saving for retirement or will be poor by retirement just because there are no easy long-term savings products available for them. They're basically, it's the Nordic countries which are best prepared for retirement. The South is well below a European average of about 235% of GDP. And this is, by the way, the majority of countries. So that already alone is an imperative to have a kind of a simple product. The EU has been discussing this, and I think André was involved in this discussion about the PEP, the Pan-European, the Personal European Pension Product, but there's only one personal European pension product which has been approved by EIOPA so far, one. So it's a huge problem is the diversity, the enormous complexity, the enormous fragmentation of the market. The size of a fund in Europe is 1/10 of what it is in the United States. Of course, the costs are higher. So it is, I think, an imperative for the industry to solve this problem, to come up with a consolidation of what is available and to have a much lower cost. And if you then say there is a need for advice, first of all, if I see this long-term savings problem, apparently, even with advice, we have a huge long-term savings problem. Because even if there has been advice available and bundled with the cost of a product, the majority of the European citizens don't save long-term. And that is the issue. They want a product which gives them a return of 2 to 3% a year, but they don't do it because apparently there are huge disincentives to invest in these products. If we then look at this study which was done for the Commission last year in August, which was published in August 2020, you see that most people want independent advice, not bundled advice. And then also what I found very strange, if you say you need to pay for advice, if I keep a product for 10 or 20 years, why should I be paying for advice 10 or 20 years? I should pay once for advice, but not be charged 10 or 20 years to be paying for the advice I got once, and which may be afterwards not so good. So there are so many, for my part, kind of contradictions in the whole industry approach on this matter. And I think if industry were to be a bit more proactive, we could certainly solve this problem and certainly come up with a really much more attractive long-term savings product in the market.
What about the argument that Sean raised that it would be disruptive, though?
Sorry, what?
About the argument that Sean raised that it would be disruptive?
Sorry, about?
Being disruptive, that it would be disruptive to the structure of the industry for the way that these are solved.
I think industry can solve this. Industry knows that this issue is there since a very long time. By the way, John also said, if I interpret the rules which are there, even in the IDD as well as in MiFID II, it clearly says a conflict of interest is prohibited. If half of a cost is paid for a retrocession fee or for a commission, this is, what you pay to the distributor. This is not in the interest of the saver. For me, it's so obvious if I read MiFID, which is there since 2017, 2018, the IDD, that this is a conflict of interest. It's a fiduciary duty that you serve the interest of the saver, of the consumer. You don't serve your own interest. So my first reply to that question is apply the rules which we have. and make sure that we watch all the national supervisors, that they consistently apply this, and they don't simply rubber stamp investment funds, but that they see what will be done to make sure that the investment fund is well run, and that we don't have an enormous complexity of funds, an enormous amount of funds in the European market, which are far too small to carry the cost.
And do you want to come back on that quickly, on the point about conflicts of interest being like inherently baked into these systems?
Well, I'm sorry, but once again, the comparison is made between the US and us, and I'm very sorry, but in France, for example, the share of revenue for pension coming from second or third pillar is like 5%. And in the US is most of it. So you see, really, we cannot compare things which are not the same. And if we go back to your point about transparency and conflict of interest, we do believe that there is a room of improvement for that. And maybe the first one is just be sure that the enforcement is done for MiFID and IDD completely everywhere, in all countries, in all markets. And if you really apply, I'm sorry, but if you really apply on the market what IDD and MiFID ask, I'm sure, I am a business person, I'm in front of clients and directors. They sign what they have to pay. So it's clear. It's not that they don't understand. They understand what they sign. Second, an increase of transparency of commissions, of course. It has to be been organized. To integrate mandatory value for money requirements. It's as well something which is part of the RIS ambition and part of all providers' ambition, so it is ours as well. And finally, to test and ensure that this value for money characteristic for the product is efficient even before going to the market. So with those 4 elements, you really create an ecosystem in which the saver feels comfortable, and you create a trust. It's not they understand what they do, and the distributor and the client, they understand because it's written. So we have to be sure that it's well written and that they sign and they agree.
Okay, 2 quite different perspectives there. So, Andre, if I could ask you then what you think of the kind of politics of this strategy, because there is quite polarizing. There's been a lot of opposition already in Council. How do you see the kind of politics in Council and Parliament when this comes forward?
I think very good question. I would definitely, and I think we heard many arguments even today in this debate. I would definitely echo what has been said by the Commission earlier. I think the retail investment strategy is actually a very broad strategic document. It has something to bring. It's a policy. If we reduce it simply to the question of inducement, which is definitely very important, but if you reduce it in our political debate only to it, I think we can actually miss a good opportunity to take some areas further in Europe, and this is what we should also bear in our minds. I'm aware of the fact that this will be definitely a divisive issue. We had, I think, back in January, discussion with Commissioner McGuinness and in our Economic and Monetary Affairs Committee in the European Parliament, where she, among others, mentioned the issue of the retail investment strategy and potential ban on inducements, and it actually provoked the discussion. We had just finalized a similar issue. It's more a principle. It's not exactly copy-paste same issue. What we had the discussions in the MiFIR review and the payment for order flows vote, which became again very political. So it will be definitely a point where a lot of attention will be focused from MEPs, from member states. I'm personally part of a liberal group, so I'm always very cautious when it comes to bans, and I think what the Commission has just expressed in terms of how they approach this issue. It seems to me it sounds very reasonable. I think before taking a definitive decision, there has to be a very good debate about whether we can actually reinforce some other aspects, and we discussed that or also today, the transparency, the way distribution is done, the disclosures, but also I think and I would like to also join those who mentioned that we need to make sure that we enforce properly the rules that are in place, and we know that there is actually a big gap in this regard as well. So before actually maybe putting or giving these possibly very divisive issue on the table, I think all the other options should be also seen as part of an overall strategy.
Sean, if I could ask you as well about the politics, you're under a lot of pressure to drop a ban at this point, aren't you?
We're under pressure from both sides, if I'm honest. Obviously, we've had an avalanche of letters from the industry telling us that this is very disruptive and trying to make the case that Anne has been making. But we're also getting letters from the other side saying that this is the evidence is incontrovertible. I mean, I think there are a few things we have to argue the point and not argue things around the point. I mean, despite the higher levels of social protection, EU citizens are actually quite good savers relative to their US counterparts. We have high savings rates in the EU. So it's not a question of whether you save, it's how you save. So as Carol has said, at the moment, EU citizens save short-term via deposits in the bank. And we would like them to save a different way. The problem is when they come to save a different way, we have to make sure they're protected. And this inherent conflict of interest that keeps being brought up. I mean, if I'm paying Carol to advise Andre, who's he working for? Is he working for me or is he working for Andre? Now, the legislation says he has to work for Andre. The MiFID is clear, the IDD is clear. But, you know, Carol has a house and kids and he has to live, so I'm paying him. So let's be clear. This is an incontrovertible conflict of interest. It has to be managed. Now, it's either managed within the industry, according to the rules we've laid down, and therefore we'd expect to see the results coming out, that we're not hearing stories of cost inefficient products, and we're not hearing stories of bad experiences. And we've had so many of these stories. Either that stops, or you're looking at something more dramatic, because this is an incontrovertible conflict of interest, which, you know, Anne herself makes the point that people are not sufficiently financially literate to operate without advice. But that leaves them, of course, very reliant on their advisor. Therefore, their advisor has to do the right thing. And as a regulator, supervisor, we have to make sure that the advisor does the right thing. And if we cannot manage that conflict of interest through our standard methods, then other methods will have to be found. So it's a difficult political question. But as I said, it's not just a one-sided problem. There are people on both sides of this argument arguing strongly, and we're in the middle trying to make the right decision.
Is there a middle ground? Is there something that could be in the middle?
Well, the Commission is always accused of taking the middle ground, and then both sides will be equally unhappy. That's sort of the kind of Commission's, the kind of caricature of the Commission's position. We try to make everybody equally unhappy. Actually, it's not what I follow for myself as a rule. I think we have to make the right decision, and my commissioner and the college as a whole will try to listen to the arguments on both sides and come forward with what we think is the right decision. It'll be balanced because it's right.
Okay, and if I could ask Andre as well, you know, you're a bit of a digital expert. Do you think there should be something in this strategy to kind of help with digital distribution or potentially on crypto side of things?
Yes, definitely. I mentioned it at the beginning. I think this is a part that really needs a lot of attention in many areas, actually. And I think it has been said that the retail investors would access the market through intermediaries, but they also are accessing already now through various digital tools or products that use digital tools. Obviously, the crypto is very specific part of it, but it takes some part of investment experience, if you wish, so of retail investors, and it is extremely easy actually to do something like that, and it's also extremely risky, which not everybody is fully aware of. But I think to make better use of digital tools, this is a necessity. On one hand, to make the investment, if possible, easier. There may be a lot of obligations and a lot of things that the investment funds need to comply with that can be actually digitalized and then offered to the customer in a more accessible way. But also, I think, as I said, there is already a lot of digital products that are offered to the retail investors without possibly enough awareness of what these products can actually bring. We have, products that are offered through social media. When I look at my wall and on some of my social media accounts, there's a lot of various investment funds offering me a lot of things, corporate bonds, etc., etc. I think this is something where we need to provide a good regulatory framework from our side to make sure that even through the digital channels, the investors are well protected. But I think there is a lot of opportunities that these channels would also be offering, and we should tap into this potential and tap into these opportunities also in the retail investment strategy. If we don't do it, retail investors will find their ways anyway. So I think this is actually sort of an urgent necessity to take this into considerations and make sure that we react properly.
So that's probably a good note to wrap up a little bit on in terms of the opportunities that are in the retail investment strategy as well. But we now have a kind of 10-minute on-site Q&A with the audience. So if anybody has a question for the panelists, please put your hand up. Anybody? If not, I'll keep asking questions. Yeah, great. I'm sorry, I should have asked where you're from, and just so that people know. So I'm from the Netherlands, I know that, for example. And where do you work? Sorry, what's your name and where are you from? My name is Linda from Boer, and I'm an independent advisor. Okay, so Carol, someone's a fan of your perspective there, I think. But any other, that was great. But any other questions in the room? Any other points? We've got mics now as well. But I mean, one question I have as well is on the supervision side. You raised it earlier, but that falls into your statement just there. But is tougher supervision one way in the middle of this to kind of make sure that there's not so many conflicts?
I think it starts with tougher supervision, but start probably with a positive message, meaning the effects of MiFID II, which came into force in 2018, takes probably 2 or 3 years to be visible in statistics. ESMA said in its latest report, I think which was published in January, we start to see some lowering of the cost in the newly approved funds, which is much more, declining much more than the older funds which in the market. So apparently we start to see, in fact, which then supports this point, let's say we need to apply the rules which are in the market, but do it in a stricter way. We see that ESMA is also, becoming stricter on supervisory authorities. They had an action, for example, with Cyprus. They said, look, you approve far too many things in relation to the number of supervisors which you have. If you approve 100 of funds and you have only 4 supervisors which are approving the funds, you can't do your work properly. These are some very simple metrics which you can do, which is not only a matter of looking at inducements, but just look, can supervisors do the work they are supposed to do? It's also very well known that in Luxembourg approves far too many funds as compared to the number of supervisors they have. Yeah, I can say this, I'm not a supervisor, so I'm an independent observer. But I hear this very often from supervisors. How can they ever do their work well? So if you already were to then have a proactive approach of supervisors to say, you want to have this fund approach, but what is your strategy, Bank X or insurance company Y, to have the size of the fund, what will be your total cost, how will you sell it to the consumer, etc., rather than simply after 2 or 3 days, whoop, it's approved, and you have the fund and you can circulate to the market, because Europe's biggest problem is oversupply of funds. We have about 36 or 37,000 funds in circulation, in which nobody can find his way anymore. And on top of that, the thing which I didn't mention, which also ESMA found out, the cost for an institutional investor to invest in these retail and these funds, which are also bought by institutional investors, is half of what it is for a retail investor. So basically, if you then see this in an overall thing of, let's say, we need to support saving for the old age, which is above all a problem for the poorer people, we're basically paying the poorer group of the population for the others, which is just inconceivable. We really need to tackle this problem, and that's why, which is so well organized in the Nordics, and of course the Nordics are also against this ban on inducements, but the Nordics have a much more proactive attitude, if you exclude the Netherlands and the UK, in approving funds, and they see there in a post-factum way and in a pre-approval way, they see their supervisors, their bankers, very much more often to say, look, if you will do these funds, we'll only approve it in these and these and these conditions, and at the condition that the overall fee is so much. And that's why you see, for example, in Denmark and in Sweden, the average cost is much lower than it is in the rest of Europe because of a proactive approach of supervisors. And I think a lot can be done in this, but that's what John said. Let's say it's a matter of a multiple approach which we need to have to help consumers to address this issue and to save long term. It's not one single thing which has to be addressed. That I agree.
Sean, is that something that's being considered, a kind of tougher supervision? Luxembourg and Cyprus are approving too many funds?
Well, we will not handle such a thing in our retail investment strategy per se. There will be an enforcement side of this. We will look at, I think as Andre was saying, at digital marketing, those kinds of issues we would certainly want to look at. We would also want to look at some of these cross-border issues. But I think, what Carol is basically saying to us is that there are inefficiencies in the EU system. Those inefficiencies are there. And at the moment, we have to work out who's bearing the cost of those inefficiencies. And what we absolutely don't want is that the retail investor bears the cost of those inefficiencies, that are kind of shifted onto the retail investors. And there are other ways of addressing those costs, which he has mentioned, but at least in this very narrow discussion we're having now, it's very important that this cost is not shifted through the system and ends on the retail investor. And that, of course, is the suspicion, at least the concern that is coming out of sort of the studies and the work that we have been doing. On the specific issue of conflicts of interest, it is quite difficult. And of course, we have spoken to the supervisors about enforcement around this conflict of interest. But typically, as I said, because of information asymmetry, the retail investor will sign a form. He will sign a form to say that something has been disclosed to him or her. But whether him or her will have understood what has been disclosed to them or the implications of what they have disclosed to them, for example, that they will pay for advice over 10 years of their investment rather just on the day they get it, is not entirely clear, but they will have signed something. So it's difficult to enforce. And this is why the whole issue of a ban has come up, because regulating and supervising and enforcing it through that method, through those means, which normally works in standard conflicts of interest where you don't have this information asymmetry, where you have more sophisticated participants on either side of the discussion may not work so well when you have this information asymmetry. And it's something the industry needs to think about, because it's not a great look. And whatever we choose to do, I think it's something that we, together with the industry, will need to work on, because it's very important that any of these efficiencies in the system do not end up being paid for by the retail investor.
And do you want to come back on that? The information asymmetry, it's not a great look for the industry.
This need for the information, there is different needs, and not only because there is different kind of consumers, but there is always the short term when you select your fund. You said fund, but in fact, you said there is too much fund in Europe, for example, but it's not a matter of how many funds are accessible for people. It's the scheme itself, the scheme in group pensions, the scheme in retail for individuals, the options, the guarantee. It's not only funds. We don't have to focus on fund, because really to select a fund, it's the easiest part of the selection that we have to do. The advice is more complex than just the fund. And the advice has not to be given just once at the beginning. You said when it's for 10 years or when it's for a long term over the time. The people who are saving most of the time, and if they are saving for their need, they need to save regularly. And they need to receive advice regularly, because everything is changing all the time. Their needs are changing, the markets are changing. You're not going to say you save in the same way when there is inflation, when there is no inflation. And if you want to include people, you have to be with them on a long-term period, and not only when they buy something. And the digital is key, and it's a key to entry in the market as well. But it's not enough. It's enough for people having extra money, the people that we mentioned at the very beginning. It's not enough for people who are not saving. And if our ambition is to help people to go further, we have to be with them on a long-term period. And we have to commit to a kind of service and a kind of mix between digital and a human touch, which is really needed. And digital is needed for final clients, for corporates, if it's group pension, for organization, if it's retail, and for distribution. And digital can help them in many different ways. For the ones saving, it's having a dashboard, being able to understand what's going on with the savings and maybe make decisions. For the corporate, is to design the product. And for the distributor, is to give advice. And this is as well maybe a key to progress in the way the enforcement is done with distribution, advice, and conflict of interest, because it's up to the distributor to use digital to make studies, simulations, and to provide to the retail investor different options to which he will not have access without. And if you just have a digital dashboard, they won't save by themselves.
Okay. Carol, do you want a final response to that before we wrap up?
I think I said my arguments. I could repeat it. I mean, I think if you speak about advice again, cost advice, there should be clearly a choice between bundled and unbundled, which we don't have today. The study, again, let's say, which I mentioned, which was published in August 2022, most investors do not know about inducements. I mean, the majority do not know there is an inducement charge to, I mean, that this cost is there for advice. So do they get advice? I mean, this just came out from the study. So they're paying for something which they're not aware of.
Yeah. So quite polarized views on this topic. I think everyone is waiting to see exactly what the Commission comes out with. Thank you so much for listening to this panel. There will be a networking break until 11:45, when we'll be back with Solvency II, also a polarizing topic, maybe. Thank you.
This is an age of disruption, of profound revolutionary change.
What we're really asking ministers is to empower the ambassadors. the only thing that you really push forth is the truth.
You don't see many women represented when it comes to the decisions as to how to handle the pandemic.